Inflation data coming in slightly hotter than expected this morning. Consumer prices rising 0.3% on a month-over-month basis in the month of December, pushing the annual headline rate to 3.4%. So what are some of the top plays from this report as we see the markets react to the data? We want to bring in Kenny Polcari. He's the chief market strategist at Slatestone Wealth, joining us here inside. Kenny, it's great to have you.
It is so great to be here. I think this is so great. Beautiful new studio. It's perfect.
Your first time in our brand new studio on the morning brief. All right, Kenny, let's talk about the inflation print that we got out this morning. Right. We're trying to break it down exactly what this means for investors, the top trades that they need to keep in mind.
So listen, I'm not surprised. We saw that little tick up. It was expected to be a tick higher, although it came in a little bit even stronger than that. And that just suggests that this fight against inflation isn't necessarily over the way the market had prepared us for, in the last 8 weeks of the year when they were talking about inflation's coming down and we're going to 2% and you got to buy everything. And we saw the markets rally. I think that investors need to just pay attention to really what the narrative is going to become. And again, it depends on who you are as an investor. Are you a long-term investor or are you a day trader that's looking for the daily volatility? Because if you're a day trader looking for that, you want to react to any headline that's out there, because anything that makes the market move is what's good for you. But as a long-term investor, you really have to sit back, right? This doesn't necessarily change my outlook on what to do and how to allocate funds and how to allocate assets at all. What it might make me do is just be a little bit more cautious and not chase things and be a little bit more patient. And any new money, I think, will be added to more defensive sectors like healthcare and consumer staples versus tech, which is on fire. Right? We still own it. It's still part of the portfolio. But I'm not going to chase it up here. I'm going to wait because I do think the market's going to pull back.
Does it make you hesitant to then trade a Fed cut at this point?
Yeah, but I was in the camp that the Fed wasn't going to cut all along. This idea that, they're going to cut 5, it's what started out as we're going to hold rates higher for longer, suddenly turned into, and we're not talking about rate cuts, suddenly turned into, we're talking about it. And then it suddenly turned into 4 and 5 rate cuts or 5 and 6 rate cuts, by the summer.
Well, we haven't gotten the first one yet.
We haven't even gotten the first one yet. And today's data suggests that, that whole idea of March is probably going to get pushed back. But then also don't forget it's a presidential election year. And the Fed cannot be cutting going into a presidential election for the sake of being seen as political, right? And so the Fed's actually not supposed to do anything 6 months in advance of a presidential election, which really means if they're going to cut rates or if they're going to do anything, they got to do something between now and really May, right? Because after May, then you're too close to the election. Now, doesn't mean they can't. They can if we fall off the edge and there's a real reason for it. Can they always do it? Yes, they can. But if the economy remains the way we're going, which seems to be okay, unemployment's at historic lows and the consumer seems to be spending money like there's no tomorrow, then there's no real reason to cut rates. And by the way, remember, if you cut rates, you're stimulating the economy, which would then reignite potentially inflation.
Do you think, though, we're going to see a bit of a deterioration? We already started to see it when you take a look at the holiday sales number. When you take a look at a lot of those consumer discretionary plays under a bit of pressure there. Are we starting to see, though, that narrative, the fact that the consumer had been so resilient now for so long, starting to shift?
Listen, I've been saying that for a while. Yes, I think the consumer is stretched. And I think you're going to start to see that as, we get more news on credit card debt and credit card potential defaults. I mean, there are 10-year highs at the moment, credit card defaults and auto loan defaults. And I think that's only going to get more difficult because, look, even if the Fed cuts rates, Bloomingdale's and Nordstrom's and J.Crew are not cut. They get usurious 30% rates on their credit cards. They're not cutting those a penny if the Fed cuts rates. So there's really no benefit to the consumer. Rate cuts, okay, mortgages maybe, but how often do you buy a house? You buy a house every day? Right? You buy a house every season? No, you're not. So that's really not going to, and you're not buying a car every day either, or every season, or every 6 months. And so those rates, while they will come down, are not going to affect you as much as if you carry a balance at Nordstrom's or Bloomie's or Abercrombie and Fitch, wherever it is.
Well, that's the other component to this, right, is housing and the stickiness of inflation in the housing sector. And it was interesting what we heard from KP Homes even last night during their earnings report, saying that they're not going to necessarily, perhaps from their side, say a price mechanism be influenced or put into some of the purchasing decisions just in order to spur demand because they already have enough in backlog and they have enough in demand that they anticipate going forward, which is the other side of what the Fed does not have control of.
That's right. And so if that's true and rates have come down, we saw them tick at 8%, in October. They've now come back down. 30-year money, I think, is somewhere around 6.5. And if you go for a 5-1 arm, maybe you're in the high fives now. So they've significantly come back. But in comparison to what they were for the last 16 years at 2%, a lot of people continue to think that they're higher when actually they're almost historically normal, right? When you think about it. So there needs to be an adjustment there. And I also though think there needs to be an adjustment in prices. Prices still have to ease back a little bit because taxes are going up, the cost of owning a home is going up everywhere you look, whether it's insurance, whether it's maintenance of the house, pieces of the house, air conditioners and all that stuff are getting more expensive. And so it's got to balance out somewhere.
Do you think we'll see that though?
I think you're starting to see it in some places. Like I live in Florida, but I live along the water. So along the water, those prices don't really they don't come in.
Yeah.
They don't come in that quickly, right? But if you go further west into Florida, like on the other side of 95, you are starting to see some softness in the house because you're further away from the water, and they're building like crazy out there. So there will be more supply. So I think in certain areas you're going to start to see it.
All right, we're going to petition for a Yahoo Finance Florida bureau so we can get a little bit closer to this.
Come on down.
Yeah, come on down.
Kenny, great to see you. Thanks for joining us up here in the Northeast.
Thanks for having me.